Did you know that leaving the United States might not free you from its tax system? Millions of Americans believe moving abroad means a fresh start. Yet the reality is far more unsettling, from worldwide taxation to the dreaded exit tax. From endless reporting rules to banks shutting doors on U.S. citizens, every step abroad can feel like walking deeper into a trap. And with tougher enforcement coming in 2025 and 2026, the cost of staying tied to the system may be higher than ever. Watch closely, because what you're about to learn could affect your money for life. Number 10. Permanent financial burden. Perhaps the most unsettling part of the tax trap is the reality that it represents a lifelong financial burden for every American citizen. Unlike most countries where leaving the nation or changing residence can bring closure to tax responsibilities, the United States ties its people to obligations that extend indefinitely. Unless a person goes through the expensive and complicated process of renouncing citizenship, often facing the exit tax in the process, there is no real escape. This means that whether you are working abroad, retiring in another country, or even passing wealth to future generations, the IRS maintains its claim. The system creates a form of permanent dependency, where financial obligations follow you until the very end. The permanence of this burden is most visible in the way Americans must constantly plan around IRS rules. Families moving abroad must restructure finances to comply with U.S. tax codes, even when those rules clash with local systems. Retirees hoping for peace of mind face ongoing filing requirements, annual stress, and the possibility of penalties for simple mistakes. Entrepreneurs building businesses outside America must factor in tax complications that competitors from other nations never encounter. This creates a heavy sense of inequality, where U.S. citizens are bound to rules that limit both opportunity and security. The weight never lifts, no matter how long you live outside the country. Over time, this ongoing responsibility erodes not only wealth but also a sense of freedom. The constant obligation to file, report, and comply reminds citizens that their relationship with the IRS is permanent, unless they make the drastic decision to sever ties completely. For many, this choice feels impossible, as renouncing citizenship can mean losing family ties, benefits, or a sense of identity. The result is a financial system that ensures Americans remain forever payers, locked into an arrangement that few fully understand until it is too late. The permanence of this tax burden is the ultimate symbol of control, leaving citizens to realize that the so-called American passport carries not just privilege, but also an endless price tag. Number 9. Financial surveillance growth. In recent years, one of the most dramatic shifts in the global economy has been the rise of financial surveillance systems. Through agreements like the Common Reporting Standard (CRS) and expanded enforcement of FATCA, governments worldwide now exchange detailed financial data across borders. For Americans, this creates an unprecedented level of transparency that leaves little room for privacy. Every bank transfer, account balance, or investment abroad is increasingly visible not only to local authorities but also to the IRS. What was once thought of as personal financial freedom is now tightly monitored under a global web of reporting networks. This surveillance growth has major implications for ordinary citizens, not just the wealthy elite. Even small accounts held abroad are subject to scrutiny, and errors in reporting can trigger penalties. For families relocating overseas, the discovery that their children's education accounts or local savings plans must be reported to the IRS often comes as a shock. Beyond the financial risks, the psychological pressure of knowing that every transaction is tracked creates a climate of constant vigilance. Many expats describe feeling as though they are always under suspicion, even when they are fully compliant. The idea of enjoying a fresh start abroad is clouded by the reality that the IRS is always watching. The trend shows no signs of slowing. With advances in digital banking, cryptocurrency monitoring, and cross-border data sharing, the future points toward even deeper layers of oversight. For Americans, this means that the dream of financial independence abroad grows more distant each year. Instead of embracing the opportunities of globalization, they are caught in a system that prioritizes control over freedom. The growth of surveillance ensures that there are fewer and fewer safe havens for wealth or privacy. This reinforces the essence of the tax trap. No matter where you go, your financial life remains tethered to American oversight. The promise of freedom is replaced by the certainty of monitoring, proving that escape is no longer just difficult, it may soon be impossible. Number 8. Locked investments. Another hidden dimension of the tax trap is how American citizens abroad face restrictions on certain foreign investments. While locals in other countries can freely build retirement savings, buy into mutual funds, or invest in local businesses, Americans encounter complicated rules that label many of these opportunities as passive foreign investment companies, PAF. Under U.S. tax law, PAFs are treated harshly, often subject to punishing tax rates and complex filing requirements. This means that something as ordinary as investing in a mutual fund abroad could result in sky-high taxes and administrative headaches. The outcome is simple. Americans abroad are discouraged from participating fully in the financial systems of their new countries. The problem extends into other areas of investment as well. Foreign retirement accounts, insurance policies, and property ownership structures can trigger additional reporting burdens or unexpected taxation. For example, a local pension plan might be tax-free in the host country, but the IRS may not recognize that exemption, leaving Americans with an unplanned bill. This creates a scenario where long-term savings vehicles become risky, forcing individuals to choose between staying compliant or growing their wealth locally. The sense of exclusion becomes clearer when Americans see friends or colleagues abroad benefiting from investment options that remain effectively off-limits to them. The idea of building stability abroad quickly collides with the reality of locked opportunities. The broader consequence is a loss of financial independence. Instead of being free to diversify and adapt to local economies, Americans must shape their decisions around IRS restrictions. This distortion not only limits personal growth, but also creates resentment toward a system that punishes ordinary choices. The inability to invest without fear of penalties reinforces the perception that American citizenship is not just a legal identity but a financial chain. For many, the term locked investments captures the daily frustration of seeing doors closed simply because of nationality. It highlights how the tax trap goes beyond income or reporting. It actively prevents Americans abroad from achieving the same prosperity available to everyone else around them. Number 7. Rising enforcement in 2025-2026. As the year 2026 approaches, experts warn that the IRS is preparing for a new era of enforcement and oversight. Recent funding increases and policy updates have strengthened the agency's ability to track, audit, and pursue citizens both inside and outside the country. What once felt like a distant risk is quickly becoming a daily reality for Americans abroad. With advanced technology and access to international data sharing agreements, the IRS now has greater tools than ever before to uncover undisclosed income, hidden accounts, and reporting mistakes. For ordinary citizens, this signals a future where every financial decision is scrutinized under a magnifying glass. The enforcement push is not limited to large corporations or billionaires. In fact, many analysts believe that middle-class expats and retirees are the most vulnerable target. These individuals often lack the resources to maintain high-cost accountants or legal teams, yet they remain bound by the same complex reporting rules. Mistakes in forms like FBAR or FATCA, even when unintentional, could trigger audits or fines. As the IRS ramps up operations, the margin for error shrinks dramatically. Instead of living with peace of mind, Americans abroad are left with the constant fear that an oversight from years ago may suddenly surface and lead to serious penalties. The narrative is clear. Enforcement is accelerating, and 2025-2026 will be pivotal years. With new policies coming into effect, more treaties being activated, and increased cooperation between global tax authorities, the environment is shifting toward zero tolerance. Citizens who once relied on being too small to notice are now directly within the scope of enforcement campaigns. The message is unmistakable. There is no safe distance from the reach of the IRS. This looming crackdown strengthens the reality of the tax trap, reminding Americans everywhere that their citizenship remains an unbreakable bond with financial obligations, regardless of border. As these changes unfold, the sense of urgency grows stronger, leaving many to wonder how much control over their own financial future they truly possess. Number 6. Loss of banking access abroad. For Americans living overseas, one of the most unexpected challenges comes in the form of banking restrictions. Due to the heavy compliance costs created by laws like FATCA, many foreign banks refuse to open accounts for U.S. citizens. From the perspective of these institutions, the administrative burden and the threat of penalties from the IRS are simply not worth the risk. As a result, ordinary Americans abroad often hear the same frustrating words: "We cannot accept U.S. clients." This creates enormous practical difficulties, because having a local bank account is essential for paying rent, receiving salaries, and managing daily life in another country. The restrictions do not stop at new accounts. Even long-term American residents abroad have reported banks closing existing accounts once they discover a client holds a U.S. passport. Imagine working in another country for years, only to suddenly lose access to your checking account, savings, or retirement plan. For families, the impact can be devastating. Without reliable access to local banking, simple tasks like paying utilities, buying groceries, or receiving school fees for children become obstacles. The inconvenience is compounded by the need to constantly prove identity, provide additional documentation, and explain one's citizenship whenever financial institutions raise questions. What should be routine banking quickly becomes a bureaucratic struggle. This issue reinforces the perception that Americans are viewed as financial risks abroad. Instead of enjoying the same freedom as local residents, they are forced to navigate barriers erected to avoid entanglement with U.S. regulation. The sense of exclusion grows stronger as options shrink, leaving many citizens dependent on costly workarounds, such as international transfers or keeping funds locked in U.S.-based accounts. The overall effect is a loss of financial freedom, where even access to basic services is restricted simply because of nationality. For many, this reality underscores the broader truth of the tax trap. Citizenship becomes less of a privilege and more of a limitation, controlling not just taxes but the ability to participate fully in everyday economic life. Number 5. IRS reporting burden. For millions of Americans, the true weight of the tax trap does not only come from paying money, but also from the endless reporting obligations demanded by the IRS. Citizens living abroad are required to file forms such as the FBR, Foreign Bank Account Report, and FATCA, Foreign Account Tax Compliance Act, disclosures. These are not optional, they are mandatory, even if you owe no taxes at all. The complexity of these documents often requires professional assistance, and mistakes can lead to devastating penalties that sometimes exceed the balance of the accounts being reported. For ordinary families with small savings or joint accounts overseas, this can create overwhelming anxiety, since even an honest error may result in life-changing consequences. The burden grows heavier because of the sheer amount of detail required. Americans must report foreign bank balances, investment accounts, retirement funds, and even certain business connections. Each of these filings demands accuracy, deadlines, and careful record-keeping, often in systems that operate very differently from those in the United States. Many expats describe feeling trapped in a cycle of endless paperwork, where living abroad means becoming a permanent financial administrator. This is especially true for retirees, who expected peace of mind but instead face a constant flood of reporting demands just to remain compliant. Rather than simplifying, the system appears designed to overwhelm, ensuring that citizens abroad remain tightly controlled. What amplifies the burden further is the severity of penalties. Even minor infractions, such as forgetting to declare a small overseas account, can result in fines that run into thousands of dollars. In extreme cases, individuals have been threatened with criminal charges. This climate of fear reinforces the power of the IRS and deters citizens from taking financial risks abroad. The result is a feeling of constant surveillance, where every move is scrutinized and every account must be documented. Far from being a system of fairness, the reporting rules act as another mechanism of control, making life outside the U.S. feel like an extension of the same bureaucratic cage. Number 4. Double taxation risks. One of the most frustrating realities for Americans abroad is the constant threat of double taxation. While the U.S. does provide certain credits and treaties intended to ease the burden, they rarely cover every type of income. This means that many Americans find themselves paying two governments on the same earnings. Consider a professional working in Europe who already pays local taxes at a high rate. Instead of that being the end of the story, the IRS demands a second filing, ensuring that no matter where you live, Washington still has influence over your paycheck. The idea of building a new life overseas often feels less rewarding when financial obligations are duplicated in this way. The problem extends far beyond salaries. Retirement accounts, pensions, dividends, rental income, and even investments are often caught in the overlap between U.S. law and foreign tax code. For example, an American saving into a local retirement plan abroad may later discover that the IRS treats those contributions as taxable in ways the host country does not. This creates confusion and at times expensive surprises. Even everyday citizens who thought they were making smart financial choices can find themselves trapped in a maze of conflicting rules. Instead of enjoying the benefits of international living, they spend countless hours and dollars on accountants, lawyers and advisors simply to stay compliant. What makes this issue especially troubling is the unpredictability of it. Tax treaties differ from country to country, and the details often shift with new policy. Many Americans abroad live in constant fear of discovering that their financial decisions triggered liabilities in both jurisdictions. For families, the stress is not just monetary but emotional, as uncertainty undermines the sense of stability they sought by moving. The double taxation system acts as a constant reminder that U.S. citizens never fully escape the reach of the IRS. It enforces the image of a financial leash, ensuring that no matter how far you travel, a portion of your income remains tethered to American obligations. Number 3. Inheritance and estate taxes. When people think about taxation, they usually focus on income earned each year. Yet one of the most overlooked aspects of the American tax system is how it treats inheritance and estates, particularly for citizens living abroad. Even if you move to another country and build your life there, the United States still maintains a claim on what you leave behind. This means your children, grandchildren, or beneficiaries could face substantial tax bills simply because of your continued American status. For families trying to pass down property, savings, or investments, this rule can reduce generational wealth dramatically. Instead of assets flowing smoothly to loved ones, they may be chipped away by layers of estate taxation that feel unavoidable. The challenge becomes even more complicated when assets are located overseas. Many countries already have their own estate or inheritance systems in place, which means families can be hit with two separate obligations, one from the local government where the assets are located, and another from the U.S. For example, a home in Europe or Asia may already face local inheritance charges, but the IRS will still count it toward the American estate tax calculation. The result is a situation where heirs may be forced to sell property or liquidate investments just to cover the obligation. Instead of creating security for future generations, the system often produces financial hardship, eroding the very foundation of family wealth. This reality reinforces why the so-called tax trap extends beyond a single lifetime. Even if you plan carefully, your heirs may inherit not only your assets, but also the tax burdens tied to them. The emotional weight of this cannot be ignored. Children grieving a loss must also confront paperwork, audits, and unexpected bills from the IRS. It sends a clear message that citizenship ties are not easily broken, stretching far beyond personal choices and into the lives of future generations. The estate and inheritance system acts as yet another mechanism, ensuring that wealth remains within the grasp of taxation, regardless of where Americans live or how they wish to provide for their families. Number 2. Exit tax penalties. For many Americans who finally decide that renouncing their citizenship is the only escape from endless taxation, there is another major obstacle waiting: the exit tax. This law is designed to treat your entire financial life as though you sold everything the day before giving up citizenship. That means your investments, businesses, properties, and retirement accounts are valued, and the potential gains are taxed immediately. Even if you never actually sold anything, the government acts as if you did, forcing you to hand over a portion of your accumulated wealth. This rule can create a devastating bill for individuals who have worked for decades to build stability, making the decision to leave America far more expensive than most anticipate. The exit tax especially targets those considered covered expatriates, which often includes people with a net worth above a certain threshold, or those who fail to meet tax compliance standards for the last several years. Once classified in this category, the penalties can be severe. Families planning to move abroad permanently may suddenly realize that their savings, intended for a new life, are heavily reduced before they even get started. The emotional toll can be just as powerful as the financial one, since many feel punished simply for wanting to change residency. For some, the exit tax acts as a psychological deterrent, ensuring that renouncing citizenship is not a straightforward choice. The impact of this system stretches beyond individuals to the broader perception of freedom. The idea that you must pay a fee to leave your country suggests a lifelong financial tether. Unlike most nations where departure means closure of tax obligations, the United States has created a system where even your exit carries a price. This effectively reinforces the tax trap, because it signals that no matter what decisions you make, there is a final barrier standing in your way. The exit tax becomes not only a financial hurdle but also a powerful reminder of how deeply intertwined the IRS is with the personal freedom of every citizen. Number 1. Worldwide taxation system. Most people assume that once they leave their home country, Their tax responsibilities end at the border. But the United States operates under a unique rule known as worldwide taxation, and this is what makes it one of the most challenging financial systems to navigate. Unlike most nations that only tax income earned within their borders, the U.S. requires its citizens to report and pay taxes on all income, no matter where it is earned. This means if you move abroad, start a business, or invest in another country, the IRS still expects its share. Imagine working in Europe, Asia, or South America, and still being bound by the same financial obligations as if you never left America. This system alone creates a sense of financial captivity, because your geographic freedom does not equal tax freedom. For millions of Americans, the impact of this rule is profound. Even if you become a permanent resident in another country, you remain tied to the U.S. tax system. The situation becomes more complicated when considering foreign income exemptions and credits, which only reduce part of the burden. For many, these technical provisions are confusing, leaving room for costly mistakes. The fear of double taxation becomes a constant concern, especially for families who relocate for work opportunities or retirees hoping to enjoy life overseas. The promise of a new beginning can quickly feel like a financial trap, where moving abroad does not mean escaping the weight of American taxes. What makes this issue even more pressing is the growing awareness of global financial transparency. Governments around the world are increasingly cooperating, and information about income, assets, and accounts is shared across borders. This means the likelihood of avoiding detection is lower than ever before. For citizens who thought they could simply move and leave their obligations behind, the truth is far different. The worldwide taxation system acts like an invisible chain, ensuring that Americans remain linked to the IRS regardless of their location. It's a rule that not only drains wealth but also limits true financial independence. The so-called tax trap reveals a system that reaches far beyond borders, reshaping the lives of Americans wherever they go. From worldwide taxation and exit penalties, to inheritance burdens, double taxation and the growing wave of financial surveillance, each piece of the puzzle reinforces the same message. Freedom from taxes is not as simple as changing your address. Even everyday tasks, like opening a bank account or saving for retirement, can become obstacles when the IRS remains at the center of your financial world. For families and individuals, this creates more than just monetary challenges. It generates a feeling of constant dependence, where decisions about where to live, how to save, and what to invest in are shaped by rules made thousands of miles away. While other nations release their citizens from obligations once they leave, the United States maintains a permanent hold, ensuring that financial ties are never fully broken. Looking toward 2025 and 2026, the tightening of enforcement makes the trap even more visible. Advanced technology, global cooperation, and stricter audits mean that avoidance or neglect is no longer possible. Instead, every citizen must recognize the weight of these obligations and how deeply they influence both present opportunities and future security. Understanding the reality of this system is the first step toward making informed choices. It shows that citizenship, while valuable, also carries an endless price tag, one that few realize until it is already too late. What do you think? Does this system protect citizens, or does it trap them? Share your thoughts in the comments. We read every one. If you missed our previous video, watch it now for deeper insights, and please support us. These videos take immense effort to create. Subscribe today. It's just one click, but it means the world to us.